Hey everyone, C Limited stock is down over 81% off its high, and in this video, I'm going to make my case for why this growth stock is an excellent buy at current valuations. I'm going to share with you its recent quarterly results. I'm going to share with you what Wall Street expects from its earnings per share over the next 5 years. I'm going to look at longer term, its revenue, its cash flow from operations, and its operating profit margin. And I'm going to finalize it with its valuation to try and explain and justify why I think C Limited is an excellent buy at current valuations. So let's begin with its latest quarterly results. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in its latest quarterly results, which the company updated on May 14th, the management said that all of their 3 business segments have delivered strong growth with an improved profit profile. So that was the key. A little while ago, the company implemented a strong focus on profitability, and that's really made the difference. As I will share with you a little bit later in the video, you'll see the dramatic improvement in the company's profitability once management started to focus on profitable growth instead of just growth at all costs. And that's been evident in the company's financial statements, and we'll see that a little bit later. So C Limited has 3 major business segments: the e-commerce segment, financial services, and digital entertainment. Let's go through each one of them. So on the e-commerce segment, Shopee delivered strong growth this quarter, achieving its highest ever quarterly orders, GMV, which stands for gross merchandise value, and revenue, all of which point to strong profit expansion with key metrics improving the way they have. On its digital financial services, C Money has continued its strong growth momentum and profitability into 2024 while maintaining prudent risk management. So not only is the financial services segment growing, but it's growing even though the company is focusing prudently on risk management. They're not just saying, let's go after growth, let's take on more risk. No, they're not doing that. They're saying, let's grow, but let's be mindful of the risks that we're taking in this segment. And management continued to say that they anticipate further growth in the digital financial services business. And finally, on the digital entertainment front, where the company has had the biggest difficulty, the biggest challenges, they're pleased to share that Garena is back to positive growth, led by Free Fire's strong performance across markets. So that's good news that this segment, which has been the most troubled of the 3 segments, has returned to positive growth, especially with the Garena segment. And that's great news as well for C Limited stock investors. Now, I highlighted that the stock price is down over 81% off its high, and those highs were reached in early or late 2021. So looking at the company's growth, it has certainly slowed down, and that can explain why the stock price is down. But I often say this with these types of growth companies: I prefer slower, profitable growth instead of faster, unprofitable growth. Because this slower growth focused on profitability is more sustainable. I'd rather have longer lasting growth at 20% than 100% growth that then fizzles out and turns out to nearly bankrupt the business, as we've seen with some other unprofitable companies that try to grow at a blistering pace. And that rate of growth is unsustainable, and it puts the company out of business, because to grow at that rate really causes disruption in the business. It causes losses on the bottom line. They neglect profitability. They just go after growth for growth's sake, and that leads to poor outcomes. So I'm not in favor of those strategies. I like this strategy here, where you're focused on profitability and growth combined. That's what matters. Profits, cash flow. Revenue doesn't matter if it's going to lead to losses and negative cash flow. Who needs that? Right? I'd rather have sustainable profit expansion along with revenue growth. 22%, perfect. I'd rather have 22% growth at profitable levels instead of 120% growth while losing significant sums of money on the bottom line. I'm not impressed with companies that grow revenue while losing a lot of money on the bottom line. I often give this example to my university students, as I'm After this video, I'm going to go to campus to lecture. And one of the examples I give is, if I was to go to the Apple store and get brand new iPhones for $800 and bring them in class and sell them for $200, my sales would explode. I would sell out probably every time I do that, because I'm taking an $800 product and selling it for $200. That's what a lot of companies do when they're growing at over 100%, 150%. They're taking a product that has much more value, that costs them much more money, and they sell it at such low prices to generate blistering growth, and that's not sustainable. And so those business models don't attract me very much. So in other words, that's a long way of me telling investors I prefer C Limited growing more slowly and more profitably. And that's what it's been doing, right? I highlighted the company made big strides in profitability, and you can see that, right? From the 2022 bottoms here, negative 15% in operating profit margin. And then when the focus shifted, you saw the profit margin rebound, or I should say this is cash flow from operations to sales, which is another metric I look at very similar to profit margin. These are two sides of a similar coin here. Cash flow from operations allows for companies that use a lot of non-cash expenses to report positive numbers, whereas operating profit margin accounts for every expense, even if they're non-cash expenses, which I'm going to look at as well. Operating profit margin, 1.24%, much smaller number, but still the trend line, you can see it working positively, right? From levels of negative 150% at 2019 up to 1.24% positive in the trailing 12-month period. I'd much rather have these positive numbers with slower growth rather than negative 100% operating profit margins with much faster revenue growth. The analysts on Wall Street that are following C Limited stock, they expect these profit expansion trends to continue. They're suggesting that over the next 5 years, C Limited will grow its earnings per share by 128% per year. That's really robust growth, and I think that's overly optimistic. In my valuation metrics, I'm not giving credit for 100%, 128% growth in earnings per share. Nevertheless, even though I'm decreasing or adjusting downward these growth expectations, even with my lowered expectations for earnings growth, it's still an attractive stock to buy at current valuations. C Limited is trading at a forward price to earnings of 19.49, which is a relatively cheap valuation for a stock with its trends. Over 20% revenue growth, all three business categories working well right now, expansion in cash flow from operations, expansion in operating profit margin, and Wall Street expectations of earnings per share in excess of 100% per year. All point to a stock that I think makes an excellent investment at current valuations. So I'm rating C Limited stock as a buy, and I'm making this recommendation on June 3rd. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.